Test 1, 2.
Welcome to Sachs Realty's Tuesday night podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Guys, welcome to our live Tuesday night podcast. And I'm sitting here in San Juan, Puerto Rico, with a friend of mine. I have renamed him. He is Money Man Mike Maloney. And we're going to have some fun tonight. Hopefully, you guys will bear with us just a little bit. We did realize, besides when we came in yesterday, we were kind of amazed that when it monsoons here, and it monsooned, that the streets flood. It was kind of interesting to watch people walking down the street and up to their knees in water. And but we also realized that the internet is not all that perfect. So bear with us tonight. But I do want to introduce Mike. Mike, tell everybody who you are, man. I'm so happy to be sitting with you.
Okay, I'm Mike Maloney. I worked with Robert Kiyosaki for many years at the height of the real estate bubble. So from 2004 through 2010, I traveled the world with Robert, giving presentations all over. And I wrote the Rich Dad's Guide to Investing in Gold and Silver, which was researched from 2002 through 2007, 2008, and written from 2005 to 2008, and came out just before the financial crisis. And I had been predicting that real estate was going to crash, and that the stock markets were going to crash, that we were in for a crisis. And it became a bestseller. And then recently I wrote another book. But I also founded goldsilver.com, which is an online precious metals dealership. And one of the things that is interesting is there is somewhat of a reverse correlation to precious metals and real estate. And during the global financial crisis, when real estate was crashing, gold was soaring. And so it was definitely, it's billed as the safe haven asset. And it really proved to be during that period of time. So, I've got sort of a diverse background. I'm an author and a entrepreneur and
Speaker maker.
I used to be an electronics engineer, and I manufactured amplifiers, preamps, and loudspeakers. And I'm a designer, and it's a lot of different things. But lately, it's economics and monetary history. That's my specialty. And I do. I started a journey in cryptocurrencies back in 2014. Just Ethereum had just been introduced, so there was Bitcoin and then Ethereum, and I knew about it since 2010 when somebody came over to my house and said, "You got," and Bitcoin was 10 cents.
I hope you bought some.
No, I didn't understand it. I ignored it. It comes back a year later, and it's a little over 25. And then he comes back, and it's over $1 in one of his 2 private planes.
Wow.
And
Wow.
And so,
one of the reasons why it's so nice to have you here is because we have some charts we're going to try and get out that you put together that's going to show what we've really been talking about for quite some time, and that the real estate market is really in a bubble.
It's the almost, years ago I called it the everything bubble, and everybody started calling. I don't know if I was the first one, but I think I may have been calling it the everything bubble. And then I realized it's the almost everything bubble. There are very, very few assets that are not in a bubble, and so and that's basically precious metals. If you compare them to the expansion of the currency supply, GDP, all of the other assets, if you price your house in gold, for instance, or the stock market in gold, you'll discover that currently gold is somewhat undervalued. But yes, one of the things I did just before coming over was have a bunch of charts updated. And the first one here, so if we could put this chart up, this is real home prices. So this is Dr. Robert Schiller of Yale University. And I have been presenting this chart since 2004. I first started presenting it.
You can't see it, Joe. Hang on one second, Mike.
And, oh, okay.
Right.
Okay, so I guess you're going to see not the presentation mode, you're going to see the presenter mode, which the presenter sees. So all the coming frames here. So where this arrow here, this is 2004, and I started presenting it back then saying that real estate was going into a massive bubble. And this data goes back to the year 1870. And so it's indexed and inflation adjusted. It's inflation adjusted, and then it's indexed at 100. So this is the percent change above and below 100. And you can see the 20s and the Great Depression, real estate was inexpensive. Now, I really do think that the 100 line sort of belongs at an average here where the 60s, 70s, 80s was. But currently, we're about 120 to 130% overvalued. And that means that in order to get back to what would be considered fair value from 1870 to the year 2000, before we went into what I call the bubble century, which we'll get into a little later, that real estate could fall by more than half if it reverted back to that fair value. And this is also compared to building costs and interest rates. If you look at Dr. Robert Schiller's data, it's a fairly complex data set. So this was just updated today. And it does show that real estate could, if we do go into a problem, especially with the, in 2008, when that crisis started, Airbnb had just started and there were only a few of them in San Francisco. Now they're all over the world. Here in San
we're sitting
Juan,
in one.
Huh?
We're sitting in one.
Yeah. Here, this is an Airbnb.
This is an Airbnb.
But there are like dozens on every block in this area. It's just huge. And so if this bubble pops and the economy slows down and people don't travel as much, we're in a tourist area, it means these places aren't going to get booked as much. And the people that have high mortgages are going to want to keep them booked, so they're going to drop their prices a little, and that means their neighbor drops their prices a little. And so, if you've got a bunch of Airbnbs, I would research how leveraged you are. How far could this thing pull back? And at what point, can you withstand a 50% reduction in revenues and still be able to make that mortgage payment without going backwards? So, it's somewhat dangerous position to be in. So the next chart here is also real estate, and this is the home price to median household income ratio. And you can see that back in the 70s, 80s, 90s, up until the year 2000, paying about 4 times your income, your annual income for a house, was about the right balance. And the thing that's interesting about this is these types of things can go back centuries. Since Roman times, you can only afford a certain percentage of your income to put a roof over your head. It's just part of it. Now, longer term loans and things like that are a fairly recent development. They didn't exist 100 years ago. You know more about all of that than I do.
Yeah, they were 5 and 6 year loans. They were interest only loans. Mm-hmm. And when they ballooned, people lost their houses.
Yeah,
they were foreclosed on. And I think that's why FHA, one of the reasons why it was formed was to try and stabilize that market. And they extended the term and dropped the interest rate, amortized the loan. And
there's another thing that it does too. If you're looking at it from the bank's perspective, it is a lot more profitable. You take out a 30-year loan, and for the first 5 years or so, you're paying only interest. There's nothing going to the principal pretty much. It's just a tiny fraction. And then you sell the home and buy another one, and you start that game over again. And so you're never actually paying for the home. You're just paying the bank its profit, because when you look at the amortization, the payment schedule of the home, the principal, once you get past the halfway point, once you're past 15 years on a 30-year mortgage, now you're paying mostly principal and very little interest.
And that's when they refinance and
Yeah,
take all their
and so it
out of the house.
resets, and you're starting with just pretty much interest only at the beginning of every loan. The first couple of years is almost interest only. This next chart, I said this, the median household income, it's the home price to the median household income. So we're up at 7 times income, but notice it doesn't say housing bubble here. It says housing bubble here in 2008, and we're way past that. So this is like up at maybe 6.8 years worth of income, and here we are at about 7.4 years of income right now. So these two charts support each other, that real estate is in a massive bubble, but it isn't just real estate. It really is the almost everything bubble. And do you want me to just continue?
Yeah, I mean,
here?
well, we can talk about this for a minute, because
Okay, good.
you really have said quite a bit in the fact that depending on what happens over the next 6 months or so, maybe the next year, with interest rates, we're in a very interest rate sensitive industry, real estate.
Yeah, I
And-
wish that this was not home price, but mortgage payment, average mortgage payment, and new mortgages. So one taken out at these new interest rates.
Right.
You can't afford nearly as much house.
Correct.
So
Yeah, so I think, and to your point, we could see a major correction from several different things happening. And today we podcasted with Peter Schiff, and he had said something about, which was kind of interesting take, and I want your opinion on it, because he said the asset really isn't the real estate right now. The asset is your mortgage.
that's the
cheap
bank's
interest.
asset. Yeah.
It's even the consumer, the home buyer, their asset is really the low rate, because
Oh yeah, if they've got an existing mortgage.
right.
Yes.
But he wasn't really considering what is happening to the expenses or the cost of real estate as it's going up, with property insurance being canceled,
Yeah.
doubling insurance rates, property taxes going up. So the borrowers that, they were lucky enough to get under 4% as a mortgage rate, a 30-year fixed mortgage rate, but now their costs are going up. So their affordability, as we're looking at the home price to median household, income ratio, if anything happens there, I mean, they're already, stretching. So the situation is, what do you think about, the Fed has paused the last 2 times. It doesn't look like they're doing QE right now.
Right. They're not.
Trying to shave it down. Where do you think, when we look at something
Well,
like
they
this?
sort of paused the QT, the quantitative tightening. Where
Have
they
they
were
paused
actually well, if I was looking at, I'm on the Fed's website all the time. I'm sort of a geek that way. But I was looking at the M2 currency supply just today, and it sort of was descending and then sort of bounced, and it's just going sideways right now. So it was contracting, and raising interest rates and having a contracting currency supply is a bad sign.
They got a lot of contracting to go. I mean,
They
trillions
do.
of dollars to get back before the
Ben
COVID
Bernanke
stimulus.
appeared on 60 Minutes years ago, right after doing all of the, in the 2008 crisis. I think it was early 2009. He was on 60 Minutes, and they said, "How confident are you that you can bring the Fed's balance sheet back to normal?" 100%. He just was absolutely. And this is one of the problems with super smart people. Sometimes they're so smart that they're wrong. They're not wrong very often, but when they are, it's a doozy, and we are all paying for this right now. Everything that is happening is, well, is it okay if I go to the next screen?
Absolutely, let's do it.
Because there was something called it's deflation, making sure it doesn't happen here. And this was Ben Bernanke's 2002 Roadmap to the Future. I discovered this speech that he gave in New York back in 2002. I discovered it in 2004. And in it, he laid out everything that the Federal Reserve could do if they took interest rates to zero and they reached the zero bound and they couldn't stimulate the economy any other way. And he came up with this list of things that he would do if he was Fed chairman. Then he became Fed chairman. I made a video on this, and it is one of the more popular videos on my channel. I think it's called Decoding Fed Speak, where I take a paragraph of his and he explains it in such complex language that it just goes over everybody's head. And then you just pick out the important words and turn them red, and you read those, and it makes perfect sense. You see everything. And he laid out like 10 different things that he would do, and they did 7 of them in the crisis, including, they called it expanding the menu of assets that he would buy. The Federal Reserve used to only buy U.S. Treasuries. Well, they added mortgage-backed securities. They added these special purpose vehicles where they could actually purchase stock in companies, and they just did this whole laundry list of things. It was about 7 out of the 10. I do believe that the 3 that haven't been done so far will be done in the next crisis. But it's something I call Bernankonomics. I don't have the list in front of me here. It's in that presentation that I made at Silver Summit in 2015, I believe. And I showed everything that he did. But when I read that paper, I changed my career. Reading that paper, I was in a business producing high-end audio trade shows. And I gave all of my shares to my business partner. I made an alliance with Robert Kiyosaki. I started writing this book. That paper was so powerful that it completely changed my life. I could see the future because I could see what the people at the top are making plans on. And he was already very influential. Now, his thesis was a book that he wrote called not America's Great Depression. It's Ben Bernanke's Essays on the Great Depression. And that is the thing that made him a very famous economist, and that's how he got to be chairman of the Federal Reserve. I've read that, and I've read Murray Rothbard's America's Great Depression, Ben Bernanke's a Keynesian. They believe in a currency supply that you can manipulate and expand and contract. Murray Rothbard's an Austrian economist, believes in free markets and a fixed free market currency supply. And then I read Milton Friedman's Monetary History of the United States, and he's a monetarist, believes in only meddling with the currency supply enough to achieve stable prices. And Ben Bernanke, in order for him to come to the conclusions that he came to, he had to ignore the inflationary run-up of the Roaring '20s that actually caused the bubble that then popped in '29 that caused the Great Depression, to be able to come to those conclusions. When you read all 3 of them and you get these different schools of economics, the Austrians blame the Federal Reserve for the Great Depression, the Federal Reserve and the U.S. government, and so did Milton Friedman. And in fact, on Milton Friedman's, I think it was his 90th birthday, Ben Bernanke was there, and he said, "You are right, Milton. We did it. We're sorry, and we'll never do it again."
And of course, he's no longer the Fed, so it won't be his fault when it happens again.
Right, exactly. So, this presentation, I was supposed to be able to wipe in lines one at a time. So this is a very busy page. I'm sorry, but we can't get it to work here with some technical difficulties. But people forget very quickly how a crisis unfolds. The global financial crisis of 2008 didn't start in 2008. Real estate it peaked really in about 2006 to 2007.
We started to see it on the new home market back in 2005.
Wow. Yeah. Okay. And then in April of 2007, New Century Financial went bankrupt. And then there was a 5-month pause. And then there were bank runs at England's Northern Rock Bank. And then there was a 6-month pause. And Bear Stearns collapsed in March of 2008. And then there was a 3-month pause. And IndyMac and Countrywide Financial collapsed. And then, so that's July. September 7th, Fannie Mae and Freddie Mac. The 15th, Lehman Brothers. The 16th, AIG gets bailed out. The 25th, Washington Mutual, and that was the largest bankruptcy in history at that point. Well, Lehman was, I'm sorry, but Washington Mutual was the largest bank failure. Lehman wasn't a bank. And then October 2008, the TARP program, November, December, January. There's just one thing, Chrysler and General Motors getting bailed out. Bank of America getting bailed out for $20 billion. The next month, February, $787 billion in stimulus. June of 2009, General Motors, who just got bailed out, files for bankruptcy and closes 14 factories. And, ending here in December of 2009 with a record of 2.9 million real estate foreclosures. So things, there's warning signs, and then something happens and everybody thinks it's over with. There's a big pause. And then another thing happens and they go, well, that was unusual. Well, back in March and April, we had, Silicon Valley Bank, Silvergate, First Republic, and I can't remember the name of the other bank. And then a month later, Credit Suisse they were going to go under if there wasn't like a shotgun marriage arranged between them and UBS. And so they were taken over. But that was a systemic, that would have caused shockwaves all over the world if that had happened. Well, if you look at the financial system really closely, this isn't over with. There's another leg down to this crisis. That was like, the bank runs, and that was like Bear Stearns collapsing in 2008. We haven't gotten to the Lehman Brothers moment yet. That happened a year later. So I'm sorry I'm laughing, but if you don't laugh, you got to cry.
It is very interesting times, and it is kind of hard when you look at the data to be overly optimistic. It depends on where you are. If you are leveraged to the max, could be really bad. If you put a lot of money, just talk about home buyers. If you put a lot of money down, you have a lot of equity and you have a great interest rate and you're able to save money. But for a lot of people, they're not at that point.
Yeah.
They just bought, they overpaid appraised value, list price. We're looking at the inflated, values. And now we're looking at high interest rates. What do you think is going to happen with that? It's kind of interesting because we're really, with the bond market the way it is right now, unless there's more QE, I don't see mortgage rates going down.
No, but, they'll go down if there's a crisis. If there's a crisis, they'll take the Fed funds rate down to zero again.
You think?
Except the mortgage rates will come down, but it'll be really hard to get a loan. It'll be hard to get approved. The requirements will be very stringent. That first chart that I showed was out of my book, the one that Robert Schiller data that going back to 1870. This book was a team of me and 4 researchers, and it took 4 years. And I stopped doing any interviews with people, no live presentations or anything. I didn't do any more events, and just knuckled down and researched and wrote that book. By the way, when it comes to the books on monetary history, economics, or precious metals, this is the only book. It's a 4.9 star rating out of 5 on Amazon, and it's 94% 5-star ratings. The second highest rated book was my first book at 76, and then everything comes, all the rest of the books come after that. So
let's talk about
the work put into it to show all of these things, and much of what I've got here comes from the book.
and years and years and years of research and
and
what I
haunting
want
the
to talk
Bank of
about.
England, the Federal Reserve, the Government Accountability Office, the Congressional Budget Office, the White House, just going to all these websites and then having researchers on my payroll that were able to gather all of this data, and a spreadsheet guru chart master, Alan Hibbard, to help put all of this together and make it presentable, and an editor and so on.
What I want to mention, Mike, when we were at dinner last night, and by the way, guys, the links, if you are interested in reading Mike's books, I highly recommend it. I'm not making money selling his books, so don't think that. We're simply doing it because I think it's a lot of, you just heard him say a lot of research, but I mean, this guy he's brilliant. I mean,
there's information that people need to know to get prepared for what's coming. Yeah. And what I've found is I do a lot of monetary history as well, because if you can look at what the economic setup is, the foundation of the economy and how it's currently twisted, what have they done? If they would let the free market work and stop manipulating things, more QE, if they didn't do QE in the first place, and they let the global financial crisis play out to its maximum in the markets, it would have been awful, but it would have been over with after just a year or two, and we would have built from a solid foundation. What they've done is, sort of plastered over some of the cracks in the foundation, but they're still there, those same cracks, and then they kept on building the building higher on top of that weak foundation. And I believe that we're in a very dangerous spot. I believe that 2024 is probably going to be very bad. When I was finishing this book, I was getting scared, actually. You know what? These aren't working, so I'm going to take them out. Sorry. When I was
You won't be able to hear the questions from Melissa. You can take them out now.
Okay.
When we get to the questions. Yeah,
okay.
We will.
There's just static on them. So when I was researching for this book, I saw so much bad stuff happening in the economy that I knew there was a banking crisis coming. I was absolutely certain of it. And it was just taking longer than I thought it should. And I was really pushing hard to get this book over the line at the end of last year. And we finally got it onto Amazon in February. And then we launched the book in February. And on the third day, Amazon changed the listing from a paperback book to a video game.
That's what I wanted to get at there.
Not find it. It was like they buried it. It was selling very, very well for the first couple of days, and then suddenly our sales were crippled by that. But I did get it out before the banking crisis in March, 1 month before. This one came out just 2 months before the global financial crisis in 2008. And so I knew there was if you research the foundation of the economy and what's out of whack, and then you look into monetary history for similar setups in the past, however that played out is going to be fairly similar to, it's Mark Twain used to say that history never repeats, but it rhymes really well. And I say that history always repeats, but with little twists. And those twists are predictable based on the setup, the foundation, at least when it comes to economics.
Well, when they make the same mistakes.
Yes, right.
How can you expect anything else?
Exactly. If you can find 100 examples of them making the same mistake in the past and it always had the same result, it's probably going to have the same result this time.
I went back to, 1789. I was looking at, they called them panics, depressions, recession. I mean, recession is not a new word. The difference was, like you said, they were every couple of years, the markets would get out of line. They would correct themselves. It would go through every so many years, 3, 2, 3, 5 years.
Was that from a book called Manias, Panics, and Crashes?
That wasn't where I gathered the data, but looking on the internet, just kind of, I actually researched it in 2009.
Okay.
So when we were going through the GFC, I was doing, I had started a business that was showcasing, it was called meetlocalbiz.com. People don't, it failed miserably. It was way before its time. And it was a deep dive into America's small business. And, I won't get into the history of it, but it was really about all the offshoring that were doing starting back in like 1982. Only 1 in 4 jobs were manufacturing offshore. But over the next several of years, we lost 4 million of our manufacturing jobs to offshoring. And by 2020, 40% of our manufacturing jobs were offshore. But anyway, I was doing a lot of work with the Restaurant Association of Maryland, and I was organizing things to present to restaurateurs. And I because they were struggling trying to get through these. I mean, it was bad. Everybody was struggling, but I mean, restaurants were decimated. I mean, it was just, they were wiped out. And so I was saying, how can I like lift these guys up? And as an entrepreneur, as a businessman, that decided I wanted anything else but real estate back then, because when it hit, I was like, man, I don't think I want to do this anymore. I mean, I've been in the industry since 1989 in one aspect or another. But when 2008 hit, I was like, man, forget this business. And that's when I was looking for other things to do. We were doing videography, oddly enough. But anyway, so I put this together, Mike, because I wanted to give them some encouragement to say, look, every couple of years this happens. How do you prepare to come out for this? I had no idea it was going to be a decade of recession, basically, to rebuild, to get back to the point. You say that the peak of the market was in 2006. Maryland, where we are, we crashed about as hard as it gets. It took a little bit longer because of our government jobs and the stable economy in Maryland. But we were one of the slowest in the entire country to come back.
Wow.
So the peak of 2006, yes, for existing home sales, builders started feeling it in 2005. Headline newspaper, back then newspapers, were the overpriced market, Baltimore housing market. We started seeing it on the news side crashing. But 06 was the peak, just like you said, for existing homes. And it took all the way to the spring of 2022 in some of these markets in Maryland for the sellers to get back to the price that they paid. Now, we know that with inflation, that means that's worse, right? I mean,
absolutely.
That's worse. It's not that if they didn't make money, they lost money, right? Even selling it at par to what they bought. Let's take some questions. Melissa, we haven't even said hello to you, man. You know what? I'm sorry. I'm so disconnected with Maryland being in Puerto Rico. It's tough. It is really tough, man. It's warm. Beach is right behind me. You can't see it because it's dark.
Mm-hmm.
And I mean, they have these
quaint
busy.
I mean, you've had a full day, and we are having trouble with the 1 hour time difference. You and I, we are not we're syncing, but we're not syncing because of the time difference. Anyway, I know you've had such a packed day. Mike, it's so good to see you. I know we've been talking multiple times, so lovely to have you on the show this evening.
Thank you.
I am going to start. You're very welcome. I'm going to start with the poll. So tonight we had the poll: is owning gold more important than owning a home in this brewing economic crisis? And right now we've got 55% saying no and 45% saying yes.
Part of it was, you said, is owning gold more important than owning a home? Do you own the home? If you own the home, it's no problem. You're going to get through this just fine. If you've got a mortgage and the bank owns your home and you haven't finished paying for it yet, there's always that question. Now, a friend of mine went through the 2008 crisis, and a colleague, and he was very highly leveraged on just real estate, and kept on adding more, acquiring more properties, getting more and more leverage. and the crisis hit, and he lost everything, and went through bankruptcy and so on. And he said to me, if I had just taken some of that equity out and instead of buying only real estate, bought some gold, the gold is reverse correlated, and I would have come out ahead. Not only would I have been protected and not lost anything, but I would have come out ahead. And so that was actually enlightening for me. Now,
Mike, that's physical gold, right?
Yes, physical gold, paper gold, like ETFs and futures. ETFs are exchange traded funds. SLV and GLD are the two biggest. And there you own a share of a trust that is supposed to hold physical gold. But if something goes wrong, you're just a creditor standing in line.
You have no control.
And you have no control. And the very fact that you can short these funds, when you short a stock or a fund, this is like GLD, supposed to hold a certain number of ounces of gold that match the number of shares that it offers. And but when you short it, the brokerage house goes into your account without telling you, borrows some of your shares, loans them to somebody else at a profit, who then sells those shares into the market. Now, two people think they own the same ounces of gold. There isn't the gold there to back it up for all of the people that are owed. Now, in the end, those shares have to be repurchased. You're short. You've sold them into the market. You've got to buy them back and return them eventually. You're hoping that the price goes down if you're short, and then you buy them back at a cheaper price than you sold them for. But they're basically borrowed, and they have to be returned.
Where do you store the physical gold? I mean, isn't that like a safety thing? I mean, you don't just keep it in your home, right? I mean, where do you have to put it?
I was the first online dealer to create storage accounts. We've got Brinks Security in Salt Lake City, Hong Kong, Singapore, Toronto, and I think England and Dubai. I can't remember. They were adding some vaults. I don't know if they're done. I don't get involved in the day-to-day mechanics.
So if things collapse, do they just prevent you from going and getting your gold? I mean, what
no, Brinks isn't part of the banking system. It doesn't fall under banking law. During the week of 9/11, the banks were closed for 1 week. Brinks was open every single day. They're open 365 days a year. They're only 364. They're closed Christmas Day. They were delivering to all of the precious metals dealers that were open that week, and the precious metals dealers became the banks. All the ATMs ran out of cash, but you could go into a precious metals dealer, and because people were worried, they were buying gold with cash. So those precious metals dealers had more cash than they had precious metals on hand, and you could sell your precious metals. And at gold went up, I think 9%, and silver went up 11% that week. So you could sell it at a profit and walk out with cash, where everybody else relying on the ATMs, they were just out of luck. And so it's a highly liquid asset that is no one else's liability. This is an important thing. The stocks, bonds, any paper asset, somebody else, it requires the performance of a counterparty. First of all, your brokerage house has to be in business and running. If the internet is down, your stocks are worthless until it comes back up. The same thing with the gold ETFs or gold futures or gold options. If you want to sell a house, you've got to go through escrow. So there's this performance of not just you and the counterpart, the person that's buying the house. There's also the performance of the bank and the escrow company that has to happen. With gold, you've got this dumb lump of metal that you can hold in your hand that has been money for 5,000. Well, actually, the last 2,500 years, roughly. That's when it was in Lydia in the 500s BC. King Croesus had it minted into coins of equal. He separated the gold from the silver and minted it into coins of equal weight. And that's the first time something actually had a price where you could say it was worth this many coins. Cows and chickens weren't fungible. And I mean, I've toured 7 national money museums. There's not too many people in the world that are that obsessed.
I think you're it, man. That's why I named you Mr. Money, because I don't think anyone has studied money more than you. And guys, you should really check out his YouTube channel. The link is in the show notes, as well as the link to his website where you can check out his books. Yeah, there we go. I'm hearing a video. All right, yeah, it's playing, right? We got, and Joe, I can't see Melissa.
I have a video series called The Hidden Secrets of Money that you may want to check out.
It's amazing.
There are 10 episodes. It's shot in 18 countries. It follows the history of money, but more importantly, how it has parallels and how it affects you today. So it opens up in front of the pyramids, and the second episode is up on the Acropolis in Greece. And, I show how basically they funded their wars with Sparta by debasing the currency supply. They take in a certain amount of, this is the world's first democracy and first free market society that had a working tax structure. And so they would take in gold and silver coins in taxes. They would melt down the gold and the silver, add 50% copper, and you take in 100 coins, and then you mint 200 coins. What's that called? It's deficit spending. For some reason, no monetary historian has ever called it deficit spending before, but that's exactly what it was. It's exactly what we're doing today. And it brought down, the great classical period of Athens, when they built all of those beautiful structures. This war, when they lost the Peloponnesian Wars, they eventually became nothing but a satellite of Rome. That ended the greatness that was Athens at one time. So history does repeat, but with little twists all the time. And so I became fascinated about it. What happened was, when my father died back in the 80s, he left my mother with an estate that should have taken care of her for the rest of her life very easily. And we hired a financial planner that was managing things. And that was during the NASDAQ bubble. And he lost more than 50% of it very, very quickly. And I was wondering why the markets were doing this. Why? And so I started studying the stock market. You can't study the stock market without studying the economy. You can't study the U.S. economy without studying the global economy. And then the people that were concerned about trade flows, budget deficits, and trade imbalances were the hard money advocates, the gold and silver people. They also are in love with monetary history, and that's when I fell in love with it. And so, yes, I've been sort of a student of it for many years, but I've toured the New York Fed's Money Museum, the Bank of England, the Bundesbank in Germany, the Beijing Monetary Museum in China, Australia Money Museum, Japan, and others. So I've seen every form of currency ever used by humans, and the history of it is actually quite fascinating if it's told properly. So,
let's take some questions.
Yes,
Melissa, can you still hear us?
I can.
We're kind of having. Yeah, good. We're
cool.
having a little bit of Joe's running around. If you guys can imagine, I brought Joe here to Puerto Rico. And he's running around going, man, this is crazy, trying to make sure that we're still streaming well. Is it coming through okay?
Yeah, you sound great. You're clear. And we've got a question from Mike here. Mike,
let's do it.
Can you hear me, Mike? Are you good?
Yes. Yeah.
Okay, perfect. Do you see a correlation between low interest rate driven asset bubbles and the massive offshoring of manufacturing? Both started at similar times and transfer our GDP to China.
Well, labor is going to go where it's low interest rates and offshoring. I've never really studied this, and I hate to make, when I haven't studied something and I don't have the facts behind it, I hate to speculate on it. But I know that, when labor is 1/4 the cost overseas, or less, 1/10 sometimes, that in order to stay competitive, companies have to do that. I'm basically a libertarian at heart. I believe in freedom. And I just don't like the ideas of borders and countries. And we hire people. We have these elections every 4 years. We have a popularity contest, and we pick the guy that isn't too bad looking, that can string 3 words together without putting his foot in his mouth, and hire him to tell us what to do for the next 4 years. And then we pay them. I mean, every time I go through a customs, or you get a ticket or something like that, we're paying these people to do this to us. I see man as, a being. You're born into the world, and depending on where you're born, for some reason, everybody else is going to impose rules and regulations on you, and tell you how to live, and force you to be part of that society. Being good to people is sort of its own reward. I see that, for me, it's the follow the leader mentality that is mankind's great downfall, that we have to elect somebody that then, to remain in power, needs to keep us afraid of other people on the other side of an imaginary line who really want the same things that we want. If the Russians weren't following Putin, if the Chinese weren't following Xi Jinping, we wouldn't. There's always got to be a boogeyman on the other side of this imaginary line, when the population is looking at what is happening, they're hearing stuff about Americans and America trying to take them over, or take over the world, or that we're taking advantage of them, or something like that. And then we hear all of this bad stuff, and it's I don't know. Offshoring and interest rates.
Let me take a shot at
that. Go ahead.
I don't know, man. Let me take a shot at it, because, Mike, ever since I've been watching your videos and reading your books, and, you're sort of intriguing me to really look at what is going on. I mean, really take a deep dive. But the way my first reaction when I hear about something like a question like this is to say, okay, so we have become a world economy.
Yeah.
Right. So,
and now it's sort of going in reverse, though. The world economy is starting to break down, which is very dangerous, because we've been.
One of the things that I'm understanding is, when we print money, it's not necessarily for us. It's to, have these swap lines with other countries, to put our money offshore. It becomes euro dollars, right? Not the euro, but euro dollars, right? And so the way I look at this is like, okay, we're the biggest buyer of gross domestic products, right? Globally.
Yeah.
And we're buying them from other countries. So how do we get our money over to them? Well, if we drop interest rates, I'm just taking a shot at it, by the way. Don't laugh at me. But if we drop our interest rates and we encourage debt or spending, it allows us to keep the money flowing, and it probably ends up offshore.
Well, I know if you drop interest rates, then it's not as attractive for foreign entities to buy our treasuries, because they're not paying very much. And so it's harder to export our debt. Now, for many years, China was neutralizing currency inflows. You buy a iPhone here in the United States, and you pay Apple, or let's say you buy it at Walmart or something like that.
My least favorite store.
Yeah, I had never been to an Walmart until I moved to Puerto Rico. But in Puerto Rico, some of the local stores have problems with inventory control. You end up having to. I mean, I had never been at one in my life until I moved here back in 2016. But if you buy a phone at Walmart, Walmart will then send those dollars over to China to order another phone to replace it so that to keep their inventory up. The Chinese manufacturer cannot use those dollars to pay their own employees. What they're supposed to do, their bank is supposed to put it on the Forex and sell those dollars and buy yuan. But that means there's a glut of dollars and a shortage of yuan on the Forex. The yuan goes up, the dollar goes down, trade goes back into balance, and you don't have as many jobs leaving the country. Now, what China did for many years, because it was more important for them to create jobs than to play by the rules, but for many years, the People's Bank of China would buy up all of the excess dollars and replace those dollars from the bank. Instead of them getting put on the Forex, People's Bank of China buys them, creates brand new yuan to give to the bank to credit the businessman's account that's going to make the replacement iPhone. When they do that, it's inflationary inside of China. And so that's how we sort of export inflation. But what it does is China had this huge buildup of foreign currency reserves. What they do is they take those yuan that they purchased and they buy U.S. treasuries. Not they're not putting them on the Forex. They get rid of all of their excess through purchasing treasuries, and what that does is it keeps the yuan artificially low and the dollar artificially high, and causes this trade imbalance to build up over, this started in the early 90s, and it went on for a long time. And that's part of the reason the jobs left is sort of cheating the system on exchange rate. It's artificially pegging your currency lower than it should be, so that your goods are very inexpensive in other countries, and our goods, the U.S. goods, were very expensive over in China. And that, so I still don't know how interest rates figure into that. I'd really have to think about that and study it a bit.
You didn't like my answer.
It's possible. It's just that low interest rates, I don't know how they encourage. I mean, who's doing the borrowing?
U.S. consumers.
Oh, to buy stuff.
Yeah.
Yeah.
So if they lower the interest rates, we go out and spend money. The banks.
Yeah, it's not money, it's currency, but
well, that's another story. But I think of it as I'm just looking.
You'll find out in this book.
We can talk about it a little bit tonight too. We'll take some more questions, but it is very interesting when you teach about the difference between money and currency, and we're really going to kind of dive into people that are wanting to buy a home, and I want to talk about this crisis that is
brewing,
hovering around, brewing, big brew. But yeah, I know that. See, I look at it and I go, okay, I feel they lowered the interest rates to encourage more borrowers, more people to borrow money, lend money. The credit card company said, hey, we got great cheap money. All this is variable rate borrowing too. Home equity lines of credit, hey, it's cheap. Go out, spend money, spend money, spend money. We're buying all this stuff. Where does this stuff come from? It comes from overseas, most of it. Nothing stamped made in the U.S. anymore since like the 1980s. I can remember being a kid and whatever I bought, a lot of what my mom or what, flip it over, said made in the USA. We don't see that anymore. But yeah, so Melissa, let's keep those questions coming.
Yeah. So Mike, we have another question.
I can't hear you.
Oh, you can't hear me? How about now?
Can't hear you.
If we can't hear you, can we put this chart up for a second? And I'll show the audience what the crisis that is still unfolding. And
can you hear us, Melissa? Thumbs up if you can. All right. Okay. All right. Go ahead and talk, Melissa.
How about now? Can you hear me now?
Nope. Can't hear her.
No.
All right. There we go. Now we got you.
I'm back?
You're back.
You're back.
Okay, perfect. So we're going to go to this question. Ask Mike how big his silver stack is. He might not want to disclose that, but perhaps we could get a clue.
I'm sorry, you broke up. What was the ask Mike what?
Ask Mike how big his silver stack is. He might not want to disclose that, but perhaps
Well,
we could get a clue.
it measures in tons. I measure my wealth in tons. Yes, part of it. I'm also invested in cryptos, and after I felt like I had enough to where I was very safe. So I've got a very large ranch at the very top of Puerto Rico that has its own water source. I've got
love this.
100 solar panels and 9 Tesla power walls. I've got a Tesla Model 3, and I've got a couple of Cybertrucks on order and a Polaris electric XUV. So everything will be electric powered. I've got 2 Monarch tractors on order, so electric tractors. So everything is solar powered. We've got our own water that comes out of Toro Negro State Park, where it's 2,000 acres where there are no trails, there's no humans, no grazing, no farming. So it's some of the purest water and air in the world. This is up at my farm ranges from 2,400 feet to 3,650 feet in elevation. And so we're growing our own food. We have our own water. We've got redundant internet, Starlink, and a microwave dish. So when everybody else loses power and internet, we are still in business. And
we should live stream from there.
Yeah, Robert Kiyosaki used to talk about the 5 Gs. You want to have ground, real estate. You want to have gas, grub, food, guns, and gold. Those are the 5 Gs. And I paid attention to it, and I've now got those. So I've got real estate, but my largest position is precious metals, and then real estate and cryptos. And after I felt really safe, I started making a speculation on the bright side of humanity. I've been driving Teslas since my 2010 Tesla Roadster, and I've met Elon Musk a few times because all the Roadster owners used to get invited to all the Tesla events at the Hawthorne Design Center, right where SpaceX is, so I've been buying the original Tesla Roadster. There's only 1,500 that were made for the Western Hemisphere. There's one model called the 2.5 where it's the most refined. It's the last 500 cars. There's probably 400 left that are existing. But this is the 4th most important car in history that caused a technological sea change, a convulsion in the automotive industry that caused bankruptcies and people to have to, car companies to go out of business and everybody to have to change. And that's what is happening right now with the introduction of electric cars. And one day, people are going to realize how important this car is. I've got one with 348 miles on it. I believe that's a multi-million car one day, multi-million-dollar car one day. So those are some of my investments. I also have some mining stocks, but for me, that's another paper asset. And the mining companies, especially the juniors, are some of the biggest inflators on earth. They survive by issuing new stock issues in private placements, and it dilutes the stock float. And but during an upswing, they can way outperform the rest of they can way outperform physical gold and silver. But when gold and silver go down, they way outperform on the downside too. So you got to be really careful. So I've got some of those as a speculation, but that's pretty much my portfolio. It gets more complex though. Gold is so simple. It's just so easy. You don't get buried in stocks. You're getting all this mail and these voting things and cryptos. You've got all these different wallets and you're on different exchanges. And then one country tries to make it illegal and you got to move stuff over here. And so I really do like gold and silver. I had some real estate that was investment real estate that was right on the beach here, just up the beach, about a mile from where we're at right now. The ocean is right out this window. We're on the beach. And I sold that when I bought my farm, though. I haven't been a big real estate investor, but I did have some of the finest property on what's considered one of the nicest beaches in San Juan.
When you look at our poll that says, should you buy real estate or gold? Obviously,
A mixture.
A mixture.
Gold is insurance, and it can be insurance for your real estate.
What are your thoughts as far as, there's a lot, and I don't want to say it's a conspiracy, but there's a lot of people that believe now that the real estate is controlled to a fair extent. You have to pay your property taxes. If you don't, you'll lose it. Right. And
gold is actually one of the few things that you can actually own.
Yeah. Well, and when you look at it with insurance companies now, it seems like we're about to have an insurance crisis.
Yes.
No one's talking about that. I mean, the insurance companies, the more I look into it, they're broke. I mean, they're in deep trouble. And, a lot of it is because bad weather events, wildfires, hurricanes. I mean, they paid out a lot of money. So they're canceling policies. So when we look at, if you're in an area where your policy is going to get canceled, and by the way, the federal government encouraged a lot of the development of these, flood areas. They incentivized the builders to build in these areas, right? And then they said, we'll, provide insurance policies, which are really low. But if people own a home and they have a mortgage on the home and they're in an area where their insurance is being canceled, their house is going to lose a lot of value fast.
Mm-hmm.
Because unless they're buying it with cash and they're not worried about insurance, how are they going to sell them? So that's a control. I mean, no one's talking about this. Not to mention that some policies from last year to this year went up significantly, and now they're going up again. So some policies went up 40, 50%. Some are, I've heard stories of quadrupling. Do you see, and now when we look at, the government is so deep into backing these mortgages that if we have any kind of a crisis with that, they have to jump in and do something. And there are a lot of people that are saying that the government was going to be a fractional owner in your home in some aspect because, in California, they're already proposing first-time buyers, giving them a loan for their down payment, so that they can get in the buy a house, but they are taking part of the equity share. If you sell it, they want a piece of your equity. The government wants, right? I mean, this is what's happening. So where do you see, take us down the road of the next 12 months? I mean, I can't think beyond that. I don't think many people have the ability to think beyond that. We were in a huge election year. This is a big election year. I mean, this is crazy, right? I mean, we've created so much debt. Prices, unaffordability is off the chart, right? So this is a critical time, this election cycle. What will we see in the next 12 months? If we see people now that need to pay their mortgage payments that have been struggling since 2020, and now in November they have to pay their mortgage
where they didn't before.
Forbearance,
right?
What will happen? A new speaker that doesn't want to print more money, any bailouts at this point, right? We've got the battle of the sides going on. What's going to happen over the next 12 months?
Well, that's a very difficult question to answer, and that's very broad, and it might take longer than that. One of the things that I've noticed, it's like I interviewed a man named Rick Rule, a wonderful, he lives, I think, down in San Diego, California. He said I have accurately predicted 17 of the last 3 recessions. And I have been, when I look at the economic data, I'm quite bearish very often. But eventually I get proven right because the data is the data. And so if I like to gather all the data and create my opinions, backing out from the data. And with the debt that we've created and then raising the interest rates, meaning it makes the payment, the portion, the interest that we're paying on the debt as the total amount of bonds, when you take 30 days and 1 year and 2 year and 5 year and 7 year, 10 year, 15 year and 30 year, 20 or 30 year bonds, and you add them all together, the average rollover is right around 5 years, 4.5, 5 years. And so the entire country, the United States, has to refi every 5 years. They got to but they're doing a percentage of it every single month. Every day there's a treasury auction, every working day. And so they're refinancing part of the debt, and they're going, in many cases, Janet Yellen, when interest rates were down at 0.1%, the Fed funds rate, she wasn't issuing 30-year treasuries. She was issuing 1-year treasuries and 2-year treasuries. So our debt that rolls over, there's always a lot coming due that they have to refinance, and they're going from very, very low interest rates to now, the Fed funds is 5.33, I believe, is the effective Fed funds. So I don't know what that puts the 10-year at or the 30-year. But
can you imagine if commercial real estate rolled over every year?
Right, but we're headed right now toward $1 trillion a year of interest payments. We're just about there, and we're only 2 years into this, average 5-year refinance. So we're at $1 trillion of just interest payments, and if you continue this out at these interest rates for the next 5 years, it's going to eat up the discretionary, the remaining revenue that it's going to take all of the discretionary spending away. And we're going into these multi-trillion-dollar deficits. It's like the government has gone crazy. There was a chart that I want to show, we'll show in the next video that we do, but the government, we used to, when we would go borrow $1 and go $1 deeper in debt, 5 years later, our GDP would have grown by $6 to $8. So we could borrow our way to prosperity. But as we piled up more and more debt, that growth has shrunk and shrunk and shrunk. And then in 2008, it went negative. So for every dollar that we borrow, we end up with about 30 to 50 cents worth of growth now. So there's no way that we can, the formula that they were using before the 2008 crisis to try to put a Band-Aid on things and get through a crisis and try and make things better no longer works. It just piles up more and more and more debt. And we've dug this hole so deep now that it is impossible to climb out of.
Do you think the dollar will crash?
I think the dollar is going to be a wild ride. I do believe that Brent Johnson's dollar milkshake theory is correct, and that during a crisis, the dollar is like the safe haven asset around the world. That's the perception that everybody has. But with the recklessness of the spending and the trade imbalances that we're doing, there will come a day where people look for something safer than the dollar and U.S. treasuries. And I do think that there's going to be a spectacular, I think that actually right now there's some technical patterns on gold charts. Like there's this giant cup and handle pattern, which is a very bullish pattern, where, it was, I'm trying to flip the chart so that I guess it's time going this way. So gold went up, and then it did this bowl and then made a handle. So it's a pan and handle or a cup and handle. And it's been hitting this resistance a couple of times, and it's making what's called an inverse head and shoulders. And once it breaks that, that's typically a very bullish move. The combination of these things should add up to a slingshot move. The thing about technical analysis is it's right like 55 or 60% of the time, and it's wrong 45% of the time. So the thing is, though, I view gold and silver as something that is guaranteed by the Federal Reserve to go up, because the guarantee is that they will never stop printing currency. When there's a crisis, there will be more currency printed, period. They've shown their hand very well, especially since 2008. Their only solution, they have a toolbox full of hammers. Those the main hammers are interest rates and creating currency. Those are the two hammers. And when the interest rate nail is all pushed down to zero, they switch over to the currency hammer, and everything looks like a nail when you've only got.
It's really not funny. So, I mean, but when you use that analogy, I mean, it really is crazy. What about our jobs market? I think that's one of the, out of everything that I've seen with the real estate market, the craziness.
I think this convergence of the bubbles in the stock market, I've got charts of Robert Shiller's CAPE ratio. It's a trailing cyclically adjusted PE ratio. PE ratio is the price of a stock divided by the earnings that the company makes per share of stock. And so it gives you sort of a valuation of the company. And again, he goes back to the year 1870. And we have been in what I call the bubble century, where they never let stuff come back down to earth. Every time that there's a crisis, they paper over it by inflating everything. And it just keeps us in this bubble, but it makes each crisis worse than the last one. And so I think that we're headed for something just horrendously bad. This time there's residential is in a bubble, but the commercial is, a lot about this a lot more than I do, but commercial is really in a bad spot. And on top of it, we've got China with, I went there in 2013 and I filmed in some of their ghost cities back then. Well, they were able to fill those cities after, it takes 5 or 8 years and those cities eventually get filled. But now they've built more than there is people. And so it's impossible to fill them there. And then they've got a bad demographic problem because of the one-child policy. And so China is in some very serious trouble. And one of the things in my book, there's a chart, I'll let you see it later. There's a chart that shows recessions, I believe, in 30 different countries or 31 around the world, and it goes through dates. And you see how recessions were linked by trade. Back in the 60s, 50s and 60s, the US would have a recession, and then 6 months to 2 years later, pretty much most of the countries that we did trade with would then have a recession. Because we have a recession, we buy less stuff from them, their business slows down, they have a recession. And then it became linked by derivatives. And in 2008, we had a super synchronous event where within just a few months, every country on the planet experienced a very severe recession. And then we had COVID and we had a hypersynchronous event where it was just all. And this time when it happens, it doesn't matter whether if it starts in a major economy like China, the US, Great Britain, if there's a crisis, it's going to sweep around the world and we will all be in it. And it doesn't matter who starts it. When you've got every place in these massive bubbles, when it comes to stocks, bonds, the bond bubble is over with. The bonds, I have a chart on that. Bonds were in a bull market from 1982. And I also predicted the absolute bottom in 2017. I came up with evidence that predicted when the bottom of interest rates would be, and it pretty much nailed it. And it was all based on historic data.
Do you think the bubble will start with bank collapse? I mean,
So if we could pull up this chart, what we have here is the gold area is now banks, their assets are the loans that they make, and then these securities that they hold, mostly US treasuries. And their currency between each other is US treasuries. They are always buying and selling US treasuries, and that's going on in the background. It's something you don't see, but that's sort of their monetary system between each other. And if you look at the two different categories here, the dark blue is treasuries that they hold on their books at a price where they're intending to hold them to maturity, where if you've got a 30-year bond, you're going to hold it for 30 years. The gold area is treasuries that are currently available for sale. Those have to be marked to market, whatever the market is trading, that 2-year or 3-month, or most of it's 3-month and 1-year, 2-year treasuries, but there's 10s and even 30-year bonds. The problem is, if you look at the little blip here in 2008, this was the treasuries that they were holding, and almost none of them were these ones where they were keeping them on their books at face value. Now, the 30-year bond has fallen 52%. It's huge. It has crashed. And if you're saying on your books, I've got this $1 billion worth of 30-year bonds that I'm holding to maturity, then, and you can say that it's $1 billion worth of bonds when it's actually only worth there's a $500 million potential loss if you have to liquidate them for some reason to come up with cash. Like, for instance, if depositors want some of their funds.
That's what he was saying. Yeah,
right. That's how Silicon Valley. This is exactly what happened to Silicon Valley Bank. And this chart is actually from a presentation that I
Brent was describing that they were buying these bonds, or basically offering these loans for less than what the rates are now.
Yeah.
With the low interest rate mortgages. So the banks are losing money every single day.
Right. If you've got an existing bond that has a very low interest rate, it's not worth as much in the aftermarket as a bond that has a brand new bond that pays a very high interest rate. So as interest rates go up, the bond yields fall, and the bond price falls. And so all of the blue area, this was 2022 in this chart. I used this chart just after the Silicon Valley Bank failure in a presentation. So there's another couple of bars that have been added, but this is some very serious stuff. And it means we are in for another financial crisis, stock market crash, real estate crash. This is going to be huge. And we could be in for a currency crisis where at first the U.S. treasuries and the U.S. dollar will be the beneficiary of all of this as countries from around the world and investors rush toward U.S. treasuries as a safe haven. But the ultimate safe haven for the last 5,000 years has been gold and silver. And eventually, like right now, China and India and Turkey and a lot of the Eastern countries have been accumulating enormous amounts of gold. The West doesn't. The U.S. has the most gold, but it isn't the most gold per person. So
if we have a banking crisis, can the government bail it out?
No. The government can only, to a certain extent. In Cyprus, they did bail-ins where they stole depositors' funds. So you had if you had above a certain amount of deposits, you lost a percentage of your deposits. The government isn't big enough to be able to bail out our entire financial sector. The problem that they are in, those blue bars, the dark blue bars on that graph, is an enormous, enormous problem that is, this is measured in billions. The government could handle that. But who is the government? It means that they've got to take it from your taxes. The government doesn't have anything. The government can only point a gun at somebody, extract taxes out of them, and then give it to somebody else. That's, the government does nothing but wealth redistribution. And they don't produce. I mean, the next time you're in a traffic jam, ask yourself, and you've got to get somewhere and you're not moving, ask yourself, is this something that you would willingly open up your wallet and buy on the free market, this level of service? That's what you get from the government. They take wealth out of the private sector, which is very efficient, because if you're not efficient as a private businessman, you're going to go bankrupt. You have to compete all the time. So you've got to serve your customers the best that you can. You've got to have the lowest price and the best service, that balance. The government is going to take wealth, and then they have no competition. There's no incentives to have maximum performance and be very, very efficient. And you run it through all of those dollars that you've taken through all those departments, and everybody has to get paid. They get their little cut, and a little bit comes out at the other end and pays a teacher, or builds a road, or gets sent over as aid somewhere, or supporting a war somewhere. And it's very inefficient. And we live in what is, you only have to look at the USSR to that was a very scientific experiment. Their whole economy was run by economists and scientists that were deciding what prices were going to be and how they were going to distribute everything. And it was an utter failure. When you have a top-down, centrally planned command society, it can't work. It isn't as good as millions of people deciding what they want for themselves and using their wallet to vote for what they want, and making all of the sum total of all of these transactions in the private sector is sort of like a giant computer. It's like a giant mind, and it's called price discovery, that determines where best we should be investing or spending. And whenever people want something, that creates an opportunity, and a businessman will come in and try and fill that opportunity. Government is never good at doing these things. And so anyway, I don't know how I got off on that.
I don't know.
But when you steer the economy and you manipulate interest rates, and interest rates typically varied between 6 and 9% for 100 years before the Federal Reserve. Now they swing from 0.04% up to 22%. And so this is what has happened since the Federal Reserve took over. Their job is to keep everything stable, and look at what they've done. There used to be a boom, and then there was an offsetting bust. So there was an inflation, deflation, deflation. And over from the inception of the country until the Federal Reserve, prices were pretty stable. A home was about the same price for 100 years, a loaf of bread. And then the Federal Reserve comes along, and interest rates just went in this little narrow range, depending on whether people had anxiety and interest rates got high, or whether people were feeling good and the economy seemed to be, and interest rates go low, and depending on how much borrowing there is. So the free market does a better job at these things always. It gathers information that no central planner can possibly have access to. How can 8 guys sitting around a table, maybe it's 12 guys 8 times a year, I can't remember, but the FOMC committee,
12 guys.
How can they have all of this information at their fingertips? They don't. They've got a lot.
They're
of
looking at
research
backward-looking
and
data anyway.
Yes, yeah.
I mean, it's
like Elon Musk says, they're trying to steer the economy by looking in the rearview mirror at a videotape of yesterday.
Well, let's take up a couple more questions before we call it a night. It's guys here in Puerto Rico, they don't observe the fallback time, and it threw us off a little bit. Melissa started out by saying, "Hey, we were off by an hour." It's actually 9:30. I don't know what time is it here.
It's 10:30
10:30
here.
10:30. Yeah,
Yeah.
10:30. So
Yep.
go ahead, Melissa. Let's take a couple questions and then
Sure.
call it a night.
Yep. Here's the next question. How do you grow your purchasing power without buying productive assets like stocks, mutual funds? Gold might help maintain purchasing power, but it's still unproductive.
You know what? I want to go to a chart that I was going to show later, and this is the gains that gold has made since the year 2000. I have my first purchase was a tube of gold eagles. So 20 gold eagles in a tube. They're 1 ounce each. They cost me, the spot price then in 2002 was $315. And now they're so this tube, $315 times 20, I don't know what that is off the top of my head, but this tube is now a $40,000 tube. If you, I don't know, is this chart being shown? Okay, you can see it. So gold is up more than 500% from the year 2000, where the S&P 500 is up about 160% here. This is 6 or 8 months old. This was made for a presentation I gave earlier this year. But even if you include rolling over dividend yields in this, dividend yields have been so low during what I call the bubble century that they really don't make much of a difference. So gold has outperformed the stock market by, about triple, I guess, something like that. It's done pretty darn well. Now, you can measure when gold is overvalued or undervalued, and same thing with silver or real estate, or by taking assets and looking back in time, a long time, and you take a median price single family home divided by the price of gold, or a barrel of oil, or a bushel of wheat, ton of iron, pound of copper, the share of the Dow Jones Industrial Average. You can price your home in shares of stock, ounces of gold, tons of iron, barrels of oil. And when you're comparing two different asset classes, it's very interesting. What you see is that your house never really goes up. Gold doesn't go up. Nothing goes up. Everything is trapped in this valuation. I call it a valuation range. I call this wealth cycles. And it goes from overvalued to undervalued. If something could actually go up forever, like if gold could outperform real estate forever, there would come a day where you'd be able to buy the entire world with an ounce of gold. So it's impossible. When something gets out of whack compared to another thing, it goes from that overvalued state and then revisits undervalued. Now, the reason that everything looks like it's going up is because the only thing that goes one direction always is fiat currencies. When you're conjuring a currency into existence by borrowing it into existence, it always has to go down. It's just part of the math of a debt-based monetary system. If you borrow the first dollar into existence and you promise to pay it back with another dollar's worth of interest, but there's only $1 that exists, what do? You got to borrow that second dollar into existence, but you got to pay it back with interest as well. So it's this never-ending pit that you're digging of debt that gets deeper and deeper. And the only way to keep ahead of it is to continually borrow more currency into existence than is required to pay the interest on the debt that you owe. And so the currency supply has to expand at a quicker pace than the population and the goods and services that are being produced. When that happens, prices go up because the stuff isn't going up. The currency is storing less and less purchasing power. The currency is going down. And so prices going up is an illusion. But gold started from a very undervalued position compared to the stock market and compared to real estate in the year 2000. And it has been making gains. And that's basically what you see in this chart. So yes, it's an unproductive asset. It didn't spin off any interest. And my gold now is worth 5 times more dollars than it was back then. Now, I'll show you another chart real quick. This is the bull market of the 70s. In my book, I sort of compare it to a horse race. If you bet $1 on this asset class from the lowest price during the decade of the 70s to January of 1980, when gold and silver peaked, if you bet $1 in the stock market, you got back $1.40. If you bet $1 on real estate, you got back $2.30. If you bet $1 on gold, you got $25.10.
Wow.
If you bet $1 on silver, you got $41.30. So if you made 41 times your currency. Now, in that chapter also, you'll see that if you sold a home in 1971 and you bought silver with the proceeds, the home doubled, a little bit more than doubled in price. It went up 2.3 times, but silver went up 41.3 times. You could sell your silver and you could buy 17 of the same home that you sold 8.5 years earlier.
But isn't this, Mike, based on if you paid cash for your home? Because what about
this is
does
based
this figure
on
out
the price of a single, according to the
it,
Federal Reserve, the price of a single family
does
medium
it consider that you're paying the same amount in interest payments?
No, it doesn't consider that.
Consider that you're
right.
doing
and
maintenance
so that would even make
and replacing the
better.
roof and replacing the
right.
HVAC and replacing the bathrooms. And
so the 70s was not a good, we had what the interest rates peaked in 1980 up at like 22%. And so the 70s was
how
not
would that
a great
change this chart?
Yes, if you put that in there, your expenditures on the interest payments and so on, I'm sure real estate actually didn't go anywhere because you didn't have any interest payments that you had to make on your gold. And so there are moments in history where the safe haven asset becomes the asset with the single potential greatest gains in purchasing power. And I got convinced that we were in one of those back in 2002, going back to this chart. And so that was back in here. And I guess I could call him a mentor, but somebody that had a podcast that you could listen to and had a blog, Jim Sinclair of financialsense.com. And he was saying that when you discover a new bull market that has just happened, and we also had some moving average crossovers and some confirming indicators that said back in about 2002 that gold was in a fundamental new bull market that would continue for many years. He said the hardest thing is to not let that bull buck you off its back. And because this correction from 2012 to 2018, 2019, it took a long time. A lot of people consider that a bear market. I consider this a cyclical correction inside of a secular bull market. And even there, I didn't try to trade that because when I was trying to measure gold against the currency supply, real estate, stocks, and so on, I couldn't. It was sort of in the middle. It wasn't overvalued yet. It wasn't undervalued yet. And so, but since then, they've expanded the currency supply hugely. And so compared to the currency supply and compared to what, gold was so undervalued, you can't, if I was doing a ratio chart of the Dow gold ratio for 100 years, you would see that point in the year 2000, stocks were just tremendously overvalued. Gold was tremendously undervalued. So measuring the performance from that peak makes gold look overvalued here because it's performed so well compared to the stock market. It's only like made halfway gains, but then when you compare it to the currency supply, I don't know. I do think that we're going to be seeing in just a few years here, $3,000 to $5,000 gold, and it could get away from them, and we might be seeing $10,000 gold. I think triple-digit silver is absolutely inevitable. You have to study the special circumstances behind silver. It was $50 it hit a high intraday high on the Chicago Mercantile Exchange of $52.50. And it got up to $48 in 2011. But name anything else in society that is still selling at a discount to its 1980 price. There just isn't anything. Silver is like the only thing that is. And when you look at the gold silver ratio, that has been out of whack for a long time. The value of silver compared to the value of gold, silver is way undervalued there. So it just suggests that gold is going to do this huge repeat move of what it did back in the 70s. And a friend of mine, Dave Morgan, used to say 80% of the move comes in the last 20% of the time. And we're just entering that last 20% phase. So I think over the next few years, we're going to have a crisis, and you're going to see some spectacular fireworks. And some cryptos are just going to probably do very, very well. It's just, which ones do you pick? Bitcoin has first mover advantage. It has by far the largest market cap, and most people know about it. And now it's getting these derivatives that are being attached to it. So it's something that Wall Street is going to be trading. So it's probably going to do very well. If you get a chance, check out my episode 8 of Hidden Secrets of Money, from Bitcoin to Hashgraph. It's my journey through crypto, and the Hidden Secrets of Money. Most of these episodes are worth putting it on a big screen TV and getting a bowl of popcorn and a beer or something.
Yeah, they're very high quality production too. I mean,
I've got 2 full-time animators, and they were done to a level where they were supposed to be on PBS or the History Channel or something like that.
It's like you're watching that when you're checking out those videos. I just want to kind of talk about some things that I've heard you and some of your friends say about that really study finance. And Brent said this. I think it was Brent. Maybe it was. It may have been James Hickman. We were talking about how if you go out and you buy, and I'm not a stockbroker, by the way, guys. I'm not an advisor. I'm a real estate broker. That's it. I'm not an attorney. But I never heard it explained on how, so well on how the market fluctuates so fast in real estate, with real estate prices. And it was James. So what he was talking about was, if I buy 1,000 shares of Apple, the market price, or I sell 1,000 shares of Apple, I don't move that market price at all. But if I buy a house, because there are a single investor and, typically buying a homeowner, maybe it's a couple, whatever, buying a house based on the value that they believe that house is worth.
Yeah, you're the new comp in the area.
You're the new comp, and you move that price
in that neighborhood,
not
in
that market,
state necessarily.
Yeah, significantly. And I've been in the industry forever, and I've never really heard it explained like that. But it can also go in reverse. So when someone must sell as a distressed seller, doesn't mean that the house is distressed. It just means the seller's distressed. And their motivation is to sell it at a lot lower price than what that house has been trading for. It really moves that market.
Yeah, that's what we talked the other night about. There was a contractor that lived across the street from me that back in the 92 recession, I believe. No, this was the 2000. Yeah, the 92 recession. Yes. He lost a dozen homes, spec homes that he was building in the area. So they all went to the bank, back to the bank, and all those homes went on the market, in various stages of completion, but all basically on the same day. And, the whole neighborhood just took this big hit. And what I worry about this time around, is like the number of Airbnbs in this area and how many of them are fairly leveraged out, how many of them have a full mortgage, and then they're covering that mortgage plus profit and they're getting a cash flow. But if we have a real disaster and you've got mortgages now have to be paid again, and suddenly you've got half the number of people traveling, what happens with all of these homes that have mortgages and you don't have the income anymore to cover the mortgage? I mean, I think that the bubble that has been created is a disaster waiting to happen. And the disaster that people think that they always think that nothing will happen, everything will be all right. And the problem with nothing is that you can't count on it. Something always happens.
That's because we have this confidence that doesn't really mean anything.
Yeah.
So our confidence in something, it's like money. So if I have money in my pocket, the only value of that money is the confidence that it gives me to be able to buy things tomorrow the same as I could buy it today with that money. If I don't have the confidence in the money, it can't buy me something. It's worthless.
Yeah.
Right. So it's kind of like the house that's sold down the street for
currency is
more.
a con game. It's a confidence game. You have to have confidence. It's just a piece of paper that has been ruined because they've printed, they put a picture of a very well-respected dead guy on it and some numbers, right? But they put ink on it. So now you can't use that paper to make a list. It's a piece of paper that has been ruined.
In one of your videos, they were making what? Currency. I almost made a mistake. You're teaching me well. They made currency out of wood because they couldn't print.
Yes, in the Weimar Republic in Germany. Yeah. The difference between, Aristotle was the first one to define the key attributes of money, what money has to be. It's got to be a medium of exchange where you're using it in trade. It's got to be a unit of account so that you can put prices on things. And it's got to be a store of value. If it doesn't fulfill all of those attributes, it's not money. And so, when I was writing my first book, I realized that national fiat currencies, the debt-based monetary system, is not money. When we were on a gold standard, a $20 gold piece was $20, and it was just under an ounce of gold. So the price of gold was $20.67 per ounce. So basically, let's just say $20. It's close enough. $20 an ounce. Now it's $2,000 an ounce. That means the dollar has gone down 99%. There is 1% of the purchasing power left. A single family median price home during the Great Depression was around $3,000 cash. Now it's $300,000 for that same home. Did the home really get like 100 times larger? Is it 100 times better somehow? Or did the dollar get 100 times smaller? It's that this is what happens with a debt-based currency system, and it is theft. You work and you're storing part of your life when you're working in this currency, and then they inflate the currency supply. And whenever you bring a new dollar into existence that took no work to, when they did gold, you had to find it, mine it, refine it, mint it into a coin, and the amount of work that it took to do that equaled, if you saved up enough gold to buy a house, it was an equal amount of work invested in the money. The effort that went into creating the money was equal to the chopping down all the trees, making the lumber, paying all the guys to hammer that thing together, the cement, the everything else. And it was a fair trade. Now you've got all of these people that chop down trees and they make lumber, and and you dig up the ore for copper and the cement, you build a house, and then somebody types a number into a computer and loans that number to you, and you spend that number into circulation by buying the house. You pay the seller that number that the bank typed into your account, and those numbers are now in circulation, and they get their purchasing power by stealing it from all other units of currency. They dilute the currencies pool, and when they do that, it lowers the value of every unit of currency in existence. So if money has to be a store of value, and somebody argues that the dollar is money, because, I say, is there inflation? And if you say, yes, there's inflation, that means the currency is not storing value. If prices are going up, it isn't the things changing; it's the currency going down. And so, yeah, that's my story, and I'm sticking with it.
Unbelievable. Yeah, well, that's
certainly. I'm on this warpath to try and educate people the difference between currency and money. And only gold and silver have proven to be money over 2,500 years. They've fulfilled all of those functions. But cryptos may end up serving the same function. But I know that a debt-based monetary system can never, that's fiat, national fiat currencies, not money, because the math behind it, if it's debt-based, it cannot store value. It is not possible. Therefore, real things are guaranteed to go up eventually, and because the currency has to go down.
I think based on the amount of consumer debt, it's okay for you to be teaching us about money.
Yeah. Well,
I think that's a good thing. I think we need more of this, Mike.
Yeah.
And that's why I'm calling you Mr. Money, Mike Maloney, the 4 M's. You said nobody else has said that. So I'm coining it. I'm just putting it, documenting it right now. Okay. But I think it's great because I think that more people need to learn how to be responsible. And I think, look, we're not a society of dumb people, right? We're a society of, in some cases, misguided and not taught the fundamentals of money at a very early age. I think that would help. One of the things that opened my eyes was thinking about when you grow up in the US, you only understand dollars. When you grow up anywhere else, you understand your country's currency and the euro dollar, which is the US dollar offshore. Yeah. So they learn they have a better understanding of currency than we do, right? And money. So I think it's great, Mike. I can't thank you enough. Let's take one more. You have time for one more question?
Sure.
Let's take what, or look, we'll take as many as you want, but
I'm fine.
All right. Go ahead, Melissa.
Okay. What is Mr. Maloney's percentage of holdings in crypto, precious metals, and cash?
Good question.
I keep
they didn't ask how much percentage.
Yeah. I don't want to, I'll say that precious metals is my largest holding, and then probably my real estate. My farm is not insignificant. It's 900 acres, and at the very top of Puerto Rico, and then maybe it's cryptos, and then the farm, and then I believe that I've got 6 Tesla Roadsters that I think some of them are going to be $1,000,000 cars, but I gambled $250,000 on producing this book, and then Amazon crushed my sales by changing it from a paperback book to listing it as a video game, and they took away my browse nodes, which means it's not in the categories of finance, business and money, investing, precious metals, things like that. It's you can find it under books in bulk.
They suppressed you.
And we absolutely cannot get it changed back. And so they crushed the sales on it. And so for the first time, because I stay so over invested, and I'm always very lean on cash, I'm probably going to be selling a Roadster or 2 to replace that, because I'm still in construction mode up on the ranch.
And you said it was really hit hard with Maria.
Yeah, 7 buildings were completely destroyed, and so when I bought it, it was it's taken a tremendous amount of investment, but I'm improving the property and making it. And we are completely off the grid. And during Hurricane Fiona, everybody up there was no power in the area for a month. We were the only ones that were basically in business, so I really don't want to disclose exact percentages, and they change so radically when you're in, like, I've got something called Hashgraph is a fairly large investment. It's been one of my best investments, but it can go from, it was at a penny for quite a while, and it went up to 55 cents. And I made sales during that period of time at 20, 22.50, 25, all the way up. I just set a bunch of offers on my trading platform all the way up to $1 at 2.5 cent intervals. And it was great waking up and finding, oh, there's $50,000 in there today. So, yeah. And so there was some where I was making more than 50 times my investment back, and that was phenomenal. And in episode 8 of Hidden Secrets of Money, you'll be seeing me buy my very first Bitcoin back in 2014 when it was 1,000. And I set automatic purchases to buy every single week, and I did so all the way down to 250. And then when it started rising again, I turned it off, but I accumulated quite a bit. And then, yeah, I see gold and silver as being very guaranteed, though, because it's for central banks, it's a tier 1 asset like U.S. Treasuries. And it's something that in a crisis, everybody rushes back to. And that's when there's a performance, when everything else is going down.
Melissa, you got another one queued up?
I do. Yep. Let me hop over here really quick. And
we'll take this one and jump off.
The monetary tightening is lessening the length of the blue. Is that in the ballpark?
The monetary tightening is lessening the length of the blue. Are you referring to that chart that shows the bond? I don't know what the blue is.
I think it was.
No, that was the easing, wasn't it? Those are bonds that the banks are holding. So monetary tightening would be the Federal Reserve selling treasuries back into the market, and when they take the dollars back, those dollars vanish. The Fed's checking account basically hasn't got any, it's got a zero balance. When they buy something, dollars spring into existence. When they sell something, dollars go back into their account and vanish. And it's basically counterfeiting. It should be illegal. It's highly immoral. It causes a tremendous wealth transfer, and it caused the bifurcation of society that we've seen with the top 1% becoming extremely wealthy at the the bottom 90% has been pillaged to enrich the top 1%. And the top 1% doesn't realize that there's this huge transfer of wealth coming to them that the Federal Reserve has created. But when the Federal Reserve creates, let me see, I've got some, so this is bank reserves, but there's 4 trillion. The Federal Reserve's balance sheet got up to about $8 trillion. And it was about 800 billion before the crisis of 2008. And to do that, they buy assets. The assets that the Federal Reserve Act limits them to is U.S. Treasuries or assets that are fully guaranteed by the United States of America. And that's where Bernanke sort of got the idea, well, we've got these mortgage-backed securities now, and Fannie Mae and Freddie Mac are these government-sponsored entities. So basically, it's the government backing them. We can buy those now, too. But when they do that, they're buying through brokerage houses. And so they're buying them out of the financial sector. And then since they bought those treasuries and mortgage-backed securities out of the financial sector, whoever they bought them from wants to replace them with some other higher yielding asset. And so it pumps the whole financial sector by creating that wealth. It's inflating the financial sector, and the inflation always goes whenever you create new currency, it creates selective inflation. It's called the Cantillon effect. Richard Cantillon was the first one that described it back in the 1800s, I believe, before that, 17. But So if it inflates that area and makes it worth more compared to the rest of the economy, if you become very wealthy, if you have since 2008, if your net worth is determined by the size of your stock portfolio. When they drop interest rates, real estate investors become wealthy because what's the most interest rate sensitive thing that there is? It's real estate. And so but when they do this, it's diluting the currency supply, the purchasing power for that newly created currency. And let's not forget the difference between 1 and 1 trillion is typing 12 more zeros. It only takes a second. There is
My calculator doesn't go up that high.
So it's theft, it's fraud, it is enslavement because they're buying U.S. treasuries. The treasury that they bought for nothing. It didn't cost them anything but a keystroke. Those $8 trillion worth of assets all pay interest. Where does that interest come from? Well, if it's treasury, it comes from your future taxation. So they just bought cash flow out of your future taxation. If it's a mortgage-backed security, it comes from your mortgage payment. That's where the profit that the Federal Reserve gets that they're supposed to turn over the treasury. I've got another chart here that we'll show in a different video sometime of how far negative they've gone, but they used to turn over any of their profits to the treasury every month. Now there's just this big, huge deficit, and it's getting pretty bad looking. What I see is when you look at all of these different charts is an economy that's really out of balance. And when you get a top spinning at first, everything's in a perfect equilibrium, and then it does like a little wobble. And then it does another one, and then it starts spinning around like this, and it tips over, and the whole thing crashes. And it just seems like that's when you look at any one of these charts, ever since the 2008 crisis, everything has been out of whack. They keep on papering over things. Every crisis gets bigger, and I think we're heading toward some real catastrophe here.
Well, there we have it. Well, we appreciate you giving us so much of your knowledge, guys. If you're interested in learning more, check out his real estate or his YouTube channel. Exhausting day here.
Yeah, that's Mike Maloney, Gold and Silver, and then there's
we're linked in the show notes here.
The book, The Great Gold and Silver Rush of the 21st Century.
Yep.
There's 2 chapters online at ggsr21.com. So go there, read them. The first one is a primer on how to read charts, and it's very, very important to understand how you can be lied to, because charts are used to manipulate people all the time. And this will benefit you for the rest of your life if you can look at a chart and know if somebody's trying to take you for a ride or not. And then the other one is pretty much how the economy works and how it has been manipulated, how the monetary system works. The first one is one of the easiest chapters. It's chapter 3. Chapter 4 is probably the hardest chapter in the book. And it's online because there's information in it that changes. I'm going to be updating it soon. You can, if you're interested in the book, you can buy it then, but download those chapters, email them to a friend. They're free. Do anything you want with it. And then the other thing is goldsilver.com is a precious metals dealership online that I founded back in 2005. And it's become one of the largest online precious metals dealerships today. And we deliver gold and silver to your home. We put it in your IRA, or we can open up an account for you at Brink Security in Hong Kong, Singapore, Toronto, Salt Lake City, and somewhere in Europe. And I have mine mostly, I've got probably 99% of my precious metals assets in Salt Lake. That is about it. Goldsilver.com, ggsr21.com, and Mike Maloney Gold Silver on YouTube.
Excellent. Well, guys, if you like the video, you can let Mike and I know that you did by smashing that thumbs up and cruise on over to his YouTube channel. Subscribe to it. He has a lot more subscribers than I do, probably approaching 800,000. Deep dive into his content. I think it's fun to learn. I think you'll gain a lot of knowledge. Not obviously, don't stop buying real estate, but it is a different perspective. I think that we need to be mindful of what's going on a little bit, understand, have a little better knowledge of like Mike's saying. So with the difference between money and currency. Melissa, thank you so much for hanging out.
Thank you so much. Thank you so
holding
much.
The fort down.
Yeah, holding the fort down. Mike, thank you for being such a wonderful guest. Thank you for your time. Really valuable information. Very welcome. And we'll see you next week when you're back here, Todd, and have a wonderful rest of your time in Puerto Rico.
I may stay here. I mean, everybody's trying to convince me to just become a citizen, or we don't have to become a citizen, a residence. You would not believe how tired I am. This is like, I think this is video 4 today, 2 different locations.
Wow.
I mean, we've been running like crazy, but guys, thank you so much for tuning in on another Tuesday night. We'll see you next time.
See you next time.